Stop scrolling. I need 30 seconds of your attention before you make a portfolio decision you will regret for the next 10 years. Right now, as you are watching this video, gold is sitting at approximately $4,500 per ounce. Earlier this year, on January 29, 2026, gold hit an all-time record high of $5,595.42 per ounce. Not in the 1970s. Not during the 1980s inflation panic. Right now, in 2026. And while that was happening, while gold was rewriting financial history, millions of investors were sitting in dividend ETFs, collecting their 3% quarterly payments, feeling safe, feeling smart, and completely missing one of the greatest commodity rallies in modern market history. So here is the question I am going to answer completely and honestly in the next 15 minutes. Should you abandon your dividend strategy and move everything into gold? Or is gold a temporary panic trade that will collapse the moment markets stabilize? Because here is what the data actually shows, and I am going to give you every number, every comparison, every expense ratio, and every scenario, so that by the end of this video, you will know exactly what the institutional money is doing. Not what the headlines say, not what a Reddit thread claims, what the real data confirms. If you want institutional-grade financial thinking for free, this channel exists exactly for that. Hit subscribe before this video ends, and let us get into it. What exactly are we comparing? The assets, gold ETFs versus dividend ETFs, full breakdown. Before we go to war with numbers, let us define our soldiers. On the gold side, we have three main ETFs. Number 1, GLD, the SPDR Gold Shares ETF. This launched in 2004 and is the oldest gold ETF in the United States. It now holds over $174 billion in net assets. Let that number settle in. $174 billion. That is sovereign wealth fund money, central bank strategy money, pension fund allocation money. GLD charges an expense ratio of 0.40% per year. Every year you hold it, you pay $40 per $100,000 invested, just in fees. Number 2, IU, the iShares Gold Trust. IU holds approximately $72.7 billion in assets. Its expense ratio is 0.25%, meaningfully lower than GLD. Each share represents roughly 0.01 ounces of physical gold. For the long-term hold investor, IU is mathematically more efficient than GLD due to lower fee drag. Number 3, GLDM, the SPDR Gold Mini Shares. This is the fee king, 0.10% expense ratio, the absolute lowest among all major U.S.-listed gold ETFs. GLDM has $33.5 billion in assets. For buy and hold investors making fewer than 4 trades per year, GLDM provides mathematically superior long-term outcomes through pure cost efficiency. On a $100,000 investment, GLDM saves you $300 per year versus GLD. That compounds massively over a decade. All three ETFs hold physical gold bullion. None pay dividends. 0.00% yield. Your only return is price appreciation. On the dividend side, we have the two dominant forces. SCHD, the Schwab U.S. Dividend Equity ETF. This is the benchmark for dividend investors. SCHD tracks the Dow Jones U.S. Dividend 100 Index. To qualify for inclusion, a company must have paid dividends consistently for at least 10 consecutive years, then survive a 4-factor quality screen: cash flow to total debt ratio, return on equity, dividend yield, and 5-year dividend growth rate. As of mid-2026, SCHD manages approximately $91 billion in assets and charges an expense ratio of just 0.06%. Current distribution yield, 3.3%. Dividend growth rate historically, 10 to 12% annually. SCHD's top current holdings include Qualcomm, Texas Instruments, United Health Group, Coca-Cola, Chevron, Merck, and Verizon. Consumer non-durables, electronic technology, and health technology are the dominant sectors. JEPI, the JP Morgan Equity Premium Income ETF. This is the monthly income machine. JEPI holds approximately $41.5 billion in net assets. Expense ratio, 0.35%. Current yield, over 8% annually, paid monthly. JEPI uses a covered call overlay on the S&P 500 to generate that yield, selling call options to collect premium income. The trade-off: capped upside in strong bull markets. In flat or declining markets, JEPI's income cushion makes it one of the most stable cash flow tools available to individual investors. At current rates, $10,000 in JEPI generates roughly $68.58 per month, or $823 annually. That same $10,000 in SCHD generates approximately $27.5 per month at current yields. Two completely different architectures. One stores value in a crisis. The other generates income through market cycles. The battle begins now. Performance battle, the 2025 to 2026 data war. Round 1. Total return comparison. Let us go number by number. No opinion. Pure market data. Gold's run has been historic and verifiable. Gold surged over 70% from early 2025 through January 2026 when it hit that all-time high of $5,595 per ounce. Goldman Sachs has a Q4 2026 price target of $4,900 per ounce, and they are actually one of the more conservative forecasts. JP Morgan's target is $6,300. Wells Fargo projects between $6,100 and $6,300 by year-end. BNP Paribas forecasts a cycle peak of $6,250. These are not retail bloggers. These are the same institutions managing trillions in global capital. GLD posted a trailing 12-month total return of over 50% through April 2026. Over the past 10 years, GLD returned 13.62% annualized. IU returned 13.78% annualized over the same period, pulling ahead due to its lower expense ratio of 0.25 versus 0.40%. IU has a 5-year annualized return of 10.48% versus GLD's 10.30%. The difference comes entirely from fees. Same gold, different cost structure, different outcome. Gold ETFs as a whole have now crossed $309 billion in total assets under management across all U.S.-listed funds. In a single week ending April 2nd, 2026, during an equity sell-off, IU gained 7%. In 1 week. Now let us look at dividends. SCHD, since inception in October 2011, has delivered a 13% annualized total return. A $10,000 investment at launch has grown to over $32,000 by early 2026 with dividends reinvested. That is solid, institutional-grade compounding. The fund has beaten the majority of actively managed large-cap funds over its lifetime. But in the immediate environment of 2025 to 2026, SCHD has lagged. It underperformed not just gold, but also similar dividend alternatives like DGRO and VAG on a pure price return basis. Over a 5-year horizon, with dividends fully reinvested, SCHD returned approximately 8.6% annualized versus JEPI's 7.9%. The short-term scoreboard is not even close. Gold wins round 1 by a wide margin. But we are not making a short-term trade. We are building generational wealth strategy. So round 2 matters far more. The income equation, cash flow math. Round 2. Who actually puts money in your account? Here is where gold's story completely falls apart for an enormous category of investor, and where dividends build a permanent structural advantage. Gold yields 0, not 1%, not 0.5%, literally 0. Holding GLD, IU, or GLDM pays you nothing unless you sell. Your capital is locked into price appreciation with 0 cash flow generation. If gold stays flat for 2 years, which has happened multiple times historically, you earn nothing. 0 income, 0 compounding. You sit and wait. Now let us run the actual compounding math on SCHD. Start with $100,000 invested into SCHD today at a 3.3% yield. Year 1, you receive $3,300 in dividend income. If the dividend grows at the historical rate of approximately 10% per year, Year 2 delivers $3,630. Year 3, $3,993. By Year 5, you are receiving $4,835 per year on your original $100,000 investment. By Year 10, $8,560 per year in passive income from an investment you made once and never touched again. The stock price growth compounds separately on top of that income. This is the SCHD machine that most people completely misunderstand when they look at the surface level 3.3% yield and call it modest. Now apply that same compounding lens to JEPI. Current yield over 8% annually paid monthly. $10,000 generates $823 per year, $68.58 every single month deposited directly into your brokerage account. For retirees, for anyone needing predictable monthly cash flow, JEPI is structurally superior to gold for income generation. Full stop. No contest. The 10-year U.S. Treasury currently yields approximately 4%. Every dollar in gold is a dollar not earning that 4%. On $50,000, that is $2,000 per year in foregone guaranteed income by holding gold instead of income-producing assets. The opportunity cost of gold is real and it compounds against you. Meanwhile, SCHD investors who bought in at launch in 2011 are now collecting a yield on cost of 12.5% on their original investment. 12.5% in passive income per year on original capital, without ever selling a single share. That is the true power of quality dividend compounding over time. Round 2 belongs decisively to dividends. But we are still only halfway through the analysis. Macro defense, when everything breaks. Round 3, drawdown protection and inflation warfare. This is the section most retail investors completely skip. And it is the section where gold earns its permanent place in a sophisticated portfolio. Let us talk about what happened during the chaos. In April 2025, the CBOE Volatility Index, the VIX, hit a reading of over 52. That is classified as extreme panic territory. Markets were in freefall. Tariffs, geopolitical escalation, banking stress, a perfect storm of macro risk hitting simultaneously. During that exact week, gold ETFs were gaining. While equity portfolios were dropping 5, 10, 15% in single sessions, gold held and then accelerated. IU gained 7% in the single week ending April 2nd, 2026 alone. 7% in 1 week while stocks collapsed. Why? Because gold's beta to equities is approximately 0.20. A beta of 1 means you move with the market. A beta of 0 means you move completely independently. Gold at 0.2 is as close to non-correlated as any mainstream asset class gets. It is the only widely traded asset that systematically moves independently of both stock market risk and bond market risk simultaneously. SCHD and JEPI are equity-based. When the stock market falls 20% in a correction, SCHD falls with it. There is no mechanical protection built into a dividend ETF against broad market drawdowns. The income keeps coming, the quarterly payments continue, but the underlying portfolio value erodes. Now let us address inflation, the silent destroyer of purchasing power. The Consumer Price Index hit 327.5 in February 2026, sitting at the 90th percentile of its entire historical distribution. Core PCE rose steadily from 125.5 in April 2025 to 128.4 by January 2026. The April 2026 CPI print came in hot at 3.8%. Rate cut expectations from the Federal Reserve faded further. In this environment, gold has historically maintained real purchasing power across multi-decade periods. It does not generate income, but it does not erode against currency debasement the way a fixed dividend payment might in a high-inflation decade. Dividend growth from SCHD, historically 10 to 12% annually, has generally kept pace with or beaten inflation over long periods. But in years where inflation spikes unexpectedly, the real value of dividend income can compress faster than the dividend growth rate compensates. The institutional solution to this problem is elegant in its simplicity. The world's most sophisticated portfolio managers, managing sovereign wealth funds, endowments, and pension assets, do not choose between gold and dividends. They allocate to both deliberately. The standard institutional recommendation is a 5 to 15% gold allocation as a non-correlated macro hedge, positioned alongside a core dividend equity income sleeve. The gold ensures the portfolio against systemic shocks. The dividends run the compounding income engine. This is the answer most financial YouTube channels never give you, because it requires holding complexity without forcing a false binary choice. The $100,000 scenario: real math, real outcomes. What actually happens to your money across scenarios? Let us take $100,000 and run 4 scenarios through the data. Scenario A: 100% gold via GLDM. Year 1 income, $0. Fee cost, $100 at 0.10% expense ratio. If gold appreciates at its 5-year annualized rate of approximately 10.48%, your $100,000 grows to approximately $115,000 by end of year 3. 0 cash flow, no dividends. Full exposure to gold price volatility. Maximum inflation and macro hedge. 0 income generated. Scenario B: 100% SCHD. Year 1 income, $3,300 in qualified dividends taxed at long-term capital gains rates. Expense ratio, $60 at 0.06%. If total return continues at the 13% annualized historical rate, $100,000 grows to approximately $130,000 over 3 years with dividends reinvested. Growing income every year. Tax efficient. Drawdown exposure matches equity markets in corrections. Scenario C: 100% JEPI in an IRA. Year 1 income, $8,230, paid monthly. Expense ratio, $350 at 0.35%. Upside is capped in strong bull markets due to covered call overlay. In flat or declining markets, JEPI outperforms SCHD in income delivery. Maximum current cash flow, ideal for retirees needing monthly income immediately. Scenario D: the institutional model, 70% SCHD, 15% JEPI, 15% GLDM. Year 1 income from SCHD at $70,000. Invested, $2,310. Year 1 income from JEPI at $15,000. Invested, $1,234. Gold at $15,000. 0 income but full macro hedge. Total year 1 income, $3,544. Gold hedge, fully active. Macro protection, locked in. Drawdown resilience, meaningfully higher than a pure equity dividend portfolio. This is the actual portfolio architecture that protects and compounds simultaneously. The math is clear. The single best portfolio is not gold only. It is not dividends only. It is the engineered combination that gives you income today, income growth tomorrow, and protection when the system breaks. The verdict and your 2026 action plan. What smart money is actually doing right now. Here is what the real data tells us in 2026. Gold ETFs crossed $309 billion in total assets. Institutional money is allocating to gold at levels not seen since the 2008 financial crisis. Central banks, led by China's People's Bank of China adding to reserves for 11 consecutive months, are buying gold systematically. This is not retail fear buying. This is sovereign-level strategic accumulation. Dividend ETFs pulled in over $22 billion in the first quarter of 2026 alone. Income investing is not dying. It is accelerating. Retirees, near retirees, and income-focused investors are buying SCHD and JEPI in record volumes precisely because rate cut expectations have faded and income from quality equities is now competing directly with bond yields. The conclusion is not a winner. The conclusion is an architecture. If you are under 40 and building long-term wealth, SCHD as your core income compounder, 5 to 10% GLDM as your macro insurance, and VOO or a total market ETF for growth exposure is the complete 3-pillar system. If you are in or near retirement and need monthly cash flow, JEPI in your IRA generates over 8% monthly. Pair it with SCHD in your taxable account for tax-efficient qualified dividend income. Keep 5 to 15% in gold as your inflation and geopolitical shield. If you have 0 gold exposure right now, the data says that is a structural gap in your portfolio. Not because gold is exciting, because when the VIX hits 52 and your equity positions are down 20%, you want something that goes up or holds flat. Gold is that something. Gold makes you safe. Dividends make you paid. The combination makes you free. If this video gave you even one data point that changes how you think about your portfolio, that is the whole point of this channel. ETF Holdings USA exists to give you the institutional thinking that private wealth management offices charge $10,000 an hour to deliver. For free. Every video. Subscribe right now. Hit the bell for every notification. And drop a comment. Are you running gold, dividends, or the combination? I read every single comment, and I want to know your current allocation. The next video on this channel breaks down the exact 3 ETF combination, VOO, SCHD, and GLDM, and how to build the institutional grade portfolio with as little as $500 per month. You do not want to miss that one. Stay disciplined. Stay invested. See you in the next one.